Good afternoon. Thanks for coming. This is a real estate guide to reverse mortgages, an action-packed 2 hours of content that's going to help you be able to understand and better discuss these loans with your clients. My name's Curtis Mangus. I've been a mortgage loan officer now for 31 years. This is class number 6 that I have approved with the Real Estate Commission on various financing subjects. And this is certainly by far and away the most challenging subject that I've taught in the last 8 years or so that I've been teaching. I'd like to thank Title I for being the provider, providing the class, etc. They do a really good job. How many of you have been involved in a reverse mortgage purchase? None. All right, we have about 37 agents here, and not one has closed a reverse mortgage purchase. And this product has been around now for 8 years. So what comes to mind for me when I talk to people about that is misunderstood, misinterpreted, misconstrued, and most of all, underutilized as far as a mortgage loan product. More misunderstood and more underutilized than all the other mortgage loan products put together that are out there. And you're going to help me change that today with the product knowledge. And thankfully I sent this class into the Real Estate Commission and they agreed and went ahead and approved it for the credit. And just a few statistics I'd like to give you. 70% of people who make age 65 will need some form of long-term care. All right? 70% of homeowners age 50 to 64 still had a mortgage a few years ago. 40% of people age 65 plus still had a mortgage, twice what it was in 1992. And there are 10,000 people a day turning 65. All right? Think about that. You only have to be 62 to take out a reverse mortgage, but I saw this the other day. 10,000 people a day are turning 65. All right? And these statistics come from AARP, so it must be true, right? If it comes from AARP. So we're going to talk about a few things here with how this loan works. And anybody want to explain the rumors that they've heard? Barb?
Really expensive.
Really expensive. Okay, so we'll talk about closing costs and that's coming up. Any others? Yes?
Too high interest rate.
All right. And I find that interesting when people complain about an interest rate on a loan that they don't have to pay back, and we'll address that coming up.
Yeah.
All right.
They kick out the widow when the husband dies.
All right. And that, you know, that has happened in the past, and thankfully they changed that in August. All right. And we're going to talk about that a little bit when one was over 62 and one was under 62 as well. So we're going to go ahead and address that. Any others? Okay. Those are some of the more common ones. I'm going to hit a whole lot more that people tell me all the time that are not true. So we're going to separate fact from fiction today. All right, and I'm going to give you the straight, information on that, so at least clients and people can make an educated decision with correct information, which right now there's not a lot of out there. And so what we're going to cover is counseling, the basic loan criteria, misconceptions, fees and costs, common uses, how it can be used with a purchase. How many of you knew that you could do it on a purchase? 1, 2, 3, a few. All right, you've been able to do a reverse mortgage on a purchase now for 8 years. All right, talk about lack of information. You're real estate agents, and a lot of you don't even know that your clients qualify for one if they're over 62. How they can be dispersed on a refinance. There's a lot of different options on that. If you take out a line of credit, how your line of credit can grow. And we're going to kind of go over some case studies and some scenarios that are fairly common for people so that you'll recognize those opportunities when they come up. All right, uses, upsizing and downsizing on a purchase, relocating, and especially in your family house, and being able to double your buying power, which is what a reverse mortgage does on a purchase. It doubles that person's buying power. On a refinance, they can use it to purchase a second home, use it to gift family members, pay off their existing mortgage and no longer have a payment, prevent foreclosure, provide a consistent monthly income for life, And also, it's a very viable financial planning tool that unfortunately most financial planners don't use. Is it safe? That's one of the main things that people ask me, customers and their kids, and is it safe? And all I can say is, I've got good news, it's a government loan. I've got bad news, it's a government loan. All right? And there's good and bad to that, but it is done by Housing and Urban Development. Oh, the loan is done by FHA. Okay? In my opinion, that's about the safest bet. All loans are government loans in the end, folks. I'm sorry, I don't care what loan you're taking out. In the end, the government's in it. All right, this one's no different. But the good news of that is it does provide some stability if you can qualify and get through the paperwork and qualifications on it. All right, so yes, is it safe? It is. The counseling in it is required and mandated before the loan can be originated, and we're going to chat about that a little bit going forward. And as I said, in 2001, Congress, passed legislation making it a government program, all right, which a lot of people don't realize. The counseling, all right. When somebody approaches me, calls me about doing a reverse mortgage, I can provide them with some short, very basic paperwork on how they work, amortization schedule, that kind of thing. And the short version is only 51 pages, compliments of the government. All right, that's the short form version that I get to provide them. And if they're still interested after that initial consultation, before the loan can be originated, they have to go through the counseling. All right, it is required because before any lender can originate a reverse mortgage, they have to be able to provide that lender with a counseling certificate. All right, without the certificate, the loan doesn't even start. All right, and so you can't steer them to a particular counselor. They're given a list, they can pick it. If there happens to be a local counselor, they can take it. The vast majority of them are done over the phone. All right, and we always encourage family members to be there. However, the lender and the realtor cannot be present during the counseling. All right, they don't want them to in any way be steered or pushed. And so lenders and prohibitor are not allowed to be there. And overall, that's a good thing. After this class, you'll know what you need to understand anyway. Some of them might need to go to the counseling, but it is what it is. The myths. The bank owns the home. Not true. This is a regular note and mortgage just like any other loan. The customer stays on title, they still own the house, they can still sell the house, they can pay off the loan, they can do anything with this loan that they can with a regular loan. The titling works the same. Most loans you can't lend to a trust. Reverse mortgages allow a trust to be the borrower, which is an advantage, especially for retirees. Most other ones you have to quit claim out of the trust, close it, put back in. With this one, most trusts are acceptable, and we can just do the loan with the property in a trust. That you can outlive the loan. All right? It says in the note, due and payable on your 150th birthday. Good luck with that. All right? If you make it, great. Nobody has yet. You cannot outlive the loan. All right? So in theory, somebody could take this loan out at age 62 and live there for the next 40 years and never make a payment. Okay? Proceeds are taxable. Loan proceeds are not taxable. It does not affect their status with the IRS in any shape, manner, or form. Whether you take it as an income or a line of credit or however, it doesn't have any impact on people's status with the IRS. It does not affect Social Security and Medicare in virtually all instances. It says the borrower can be forced to leave the home. Somehow people think that somehow the government's going to come knocking on the door. What is the most common reason for foreclosure? Well, guess what? This loan doesn't have payments. All right? None. Ever. All right? So it eliminates by far and away the most common reason that people go through foreclosure, which is failure. You know the old saying, if you want to get somebody excited, skip a couple payments? Well, that's not a factor here because there are no payments ever due on the loan. All you have to pay is the property taxes and the homeowner's insurance and keep that property in good condition, which is true of any loan. Debt passes on to their heirs. I have so many clients, they're so concerned about their kids. All right, this is what's called a non-recourse loan. All right, the only recourse the lender ever has under any circumstances is to sell the property. All right, they can't go after their heirs. They can't go after their estate. They can't go after other assets. They can't go after anything other than to sell the property. All right, which is one of the most common misconceptions out there. Somehow people just know that the government's going to come after their kids or their assets or their retirement, and it's absolutely not true. That may be the most common misconception that is out there, and it is not true. All right? Why are more people doing these? Last year there were 100,000 reverse mortgages closed in this country. And at 10,000 people a day technically qualifying, there's going to be more and more of these people as the, quote, baby boomers, you know, want to retire and can retire. This loan is now becoming one of the loans of choice. And so that's one of the main reasons why people like them. They can, you know, maintain their dignity and independence longer. It often improves their quality of life. Often people are living longer. You know, the people are commonly living into their 80s and 90s. It helps them with medications and prescriptions. It helps them against Social Security loss. They want to be able to stay in their home and afford in-home health care. If they need to fix their house up, it's a way that they can draw on a line of credit to be able to fix it. What a great way to eliminate mortgage payments. Anybody who's over the age of 62 and has 50% equity in their home can take out one of these loans, pay off their first mortgage, and never make a payment again, which is one of the most common things that I see when I'm closing. And what a great way to eliminate a mortgage payment. Of course, everybody when they retire wants their house paid off. And why do they want their house paid off? So that they don't have to make a payment. Well, the only thing better, if you don't have the house paid off, the only thing better is to have it at half. Because if you're at 50%, you can take out a reverse mortgage and eliminate the payment for as long as you live in the house, and you've ended up in the same place. People want to buy cars, trucks, motorhomes, travel. All of those kind of things are allowable on line of credits when they have the equity to be able to take those out. They don't want to be a financial burden to their children. All right, and I'll show you some ways that it actually eliminates being a financial burden by being able to take one of these out. And it can stop them or prevent them from having to go back to work in their 60s and 70s and 80s. What are some of the benefits? You stay on title. People often think somehow they're signing their house and their equity over to the government or the lender, which is absolutely not true. All right? You keep your home in a trust. Any income you derive off of it is tax-free. If you're drawing money out, you can choose any way of a number of ways on how to get that income monthly in a line of credit, lump sum, at the buyer or the customer's discretion. There are a multitude of ways that we'll go over on how that can be done. Doesn't affect your property taxes at all. It's insured by Housing and Urban Development. HUD insures the loan. Good news, it's a government loan. Bad news, it's a government loan. Okay? It is an amazing tool on a purchase. All right? And I'll show you a number of ways that on a purchase it does some amazing things for people. And you can buy investment property with it. All right? Which is also a well-kept secret, and I'll show you a couple of ways that you can do that. The benefits. My favorite. You never have to pay it back as long as you live. All right? So follow this scenario with me. You walk into the bank. You want to buy a house. And you tell the banker, I want to buy a house for $200,000. I want to put $100,000 down. I'm 62 years of age. I estimate I'm going to live in that house for the next 30 years. And I have no intention of ever paying you as long as I live. And at the end of my life, or when I move out of the house, your only recourse is to sell the house. regardless of value or economic condition, the only option the bank has is to sell the property, and you cannot come after my heirs or my estate or any other assets that I have. What do you think the bank's going to say? I will guarantee you they're going to say no. All right? And that's exactly the scenario on a reverse mortgage purchase. Okay? No prepayment penalty. The general rule of thumb, the underwriting is fairly easy. You need to be 62 and you need 50% down on a purchase. All right? It's just that straightforward. It doubles your buying power. All right? Let's say somebody retires and has an IRA or a 401k with some money in it, or sells another property and has $100,000 to work with, or gets an inheritance or sells some asset and they've got $100,000 to work with. And they're 62 or older and they don't want a mortgage payment. Who wants a mortgage payment? All right? So they're thinking they have to pay cash so that they don't have a payment during their retirement. Well, $100,000 right now is like, you know, fine, we'll find you a house in Caldwell, right? Nampa? You know, $100,000 house, pay cash, no payment. Or would you rather buy a $200,000 house in Boise or Meridian and have the same result, which is no payment? So you buy a $200,000 house in Boise, take out a reverse mortgage, put $100,000 down, and have no payment for as long as you live, or pay cash for a $100,000 house, and you end up in the same place. Didn't that buyer just double their purchasing power? You would be amazed how many people would love this option and don't even know that it exists. Okay? Let's say they can pay cash. Let's say they have $200,000. All right? And they can buy that house in Boise for $200,000. My first question is, should they? If you can put $100,000 down, have no payment, what could they do with that other $100,000? What can they do with that other half? Put it in the bank? One of my favorite sayings, there's nothing better than money in the bank. Right? If you pay cash for a house, it's not that easy to get out, and under a normal loan, if you do get it out, you got to pay it back. I hate it when that happens. All right? So even if you could pay cash for a house, why wouldn't, on $200,000, why wouldn't you put $100,000 down and take that other $100,000 and invest it, put it in the bank, keep it in your IRA, or perhaps, you know, maybe buy investment property with it, some kind of income generating cash flow that they're not going to have if they pay cash for that house. You would be amazed how many people really like that idea, but the first thing they have to do is know that it's available. Okay? It keeps your reserves liquid because, as I said, it's not all into the house. You can never owe more than the home is worth. Okay? Under any circumstances ever. You can never owe more than the house is worth. All right? So you buy that $200,000 house and you put $100,000 down and you have a balance of $100,000, and 5 years later, unfortunately, we have another 2008, and the market collapses. All right? It has no impact on that loan. They can still live there for another 25 years. When the loan finally comes due, they've passed away, they've moved out of the house, you know, into assisted living, whatever it is. If they're upside down in the house, the only thing that the lender can do is sell the property. Okay? They can't go after their heirs, they can't go after the estate, they can't do anything else other than sell the property. Now then, there's mortgage insurance on this loan that we're going to talk about. MIP, you know, mortgage insurance, PMI, that the lender has as insurance if that happens. All right? So it's not actually a short sale. They just charge the mortgage insurance for the deficiency. All right? And that's how the bank gets away with being able to do that. And that's how, because of the risk, they're willing to make these loans. Because there's a pool of money out there that if they do have a shortfall, that they can charge against, so that they don't have to worry about that in the case of, you know, of taking a large loss. But what's nice about this mortgage insurance, especially on a refinance, it's the best mortgage insurance in the world because it's not due and payable until after you're dead. All right? Keep in mind, this loan is due and payable when the last borrower is deceased. And at that point, they don't care anymore. You know, suddenly it doesn't have the same impact. All regular loans with mortgage insurance, you're paying it every month. All right? This is not due and payable until the loan is due. It's not in any way something that they're paying monthly. Okay? Keep in mind it's a non-recourse loan. As I said, the only thing that they can do, the lender can do, is sell the house. And earlier this year, FHA, on a regular FHA loan, they lowered the loan limit to $271,000. All right? The limit on an FHA loan on a purchase, on a reverse, purchase or refi, is $625,000. All right? So we don't have the same limitations that we do on a regular forward FHA loan. Acceptable property types. Of course, a single-family residence, 2 to 4 unit dwelling, and we'll talk about that a little bit more in a minute. Condos, yes, manufactured homes, you know, permanent foundation, real property, you can do them on those as well. Planned unit developments, new construction. All right, you can take out a reverse mortgage on new construction. However, you cannot originate the loan until the certificate of occupancy has been done. You know, normally we'll get everything ready, get ready to close the loan. As soon as the house is done, we'll send the appraiser out to verify it and we'll close. I'm not sure why the government in its infinite wisdom says that you cannot originate a loan on a new construction until after the house is done. So you need to know that if you're writing a contract on new construction with a reverse, because you need to put it out there 45 days from when the house is done, because it's typically going to take about that long to get them closed. And that's just one of the little caveats that there is on it. And it is an FHA appraisal. All right, obviously it has to be a house in good condition, no cracked and peeling paint, because it is a regular FHA appraisal that is required. Loan requirements. This is the only loan that is absolutely age discriminatory. All right? If you're not 62, you can't have it. Okay? All other loans, I've made them to people in their 70s and 80s and that kind of thing. If you're not 62 years of age, you cannot have this loan. It is made for people either retired or planning on retiring to help them through their retirement years. All right? Primary residence only. All right? You can't take one out on a second home. You know, that kind of thing. However, on a purchase, you know, it makes sense on a single-family residence to buy one and put 50% down and not have a payment. However, they allow reverse mortgages on duplexes and fourplexes. Okay, so imagine the scenario of a $250,000 fourplex in the valley with rents of $800 a month, which I think is reasonable. So they move into one unit. You know, they buy it, they put $125,000 down, they put half down, they move into it, they have no payments. However, they're collecting rent on the other 3 units at $800 a month. What kind of an impact do you think that would have on somebody's retirement that's on $1,000 a month Social Security and that's all they have, and they got an inheritance, or you know, they worked hard all their life and they had some money in retirement, that they could buy an investment property and move into it and live in the one unit and rent out the other 3? Do you think that might change the outlook of their retirement? Nobody does this. Most people don't even know that it's an option for them. All right? And I see people in their, churning and just stop and think about that. You know, and people say, well, I don't want to be a landlord. And I'm like, really? If you've got 3 units with no overhead, do you think you could afford a property management company to manage your neighbors? They don't even have to know you own it. All right? And if you want to build one, just make sure one unit's really, really nice. And you move into that one. Build one that's exceptionally nice with 1 unit and rent out the other 3. You could live there and generate easily a couple of $1,000s a month in income after taxes and insurance and all of your expenses. What a nice way to subsidize your retirement. Because it's an FHA loan, we have to track where the money comes from. They just can't show up with cash. Normal deal. No seller concessions on a purchase of any kind. All right? And this is important. You can't ask them to pay the seller's half of the title insurance. They can't split the escrow closing fee. The buyer pays all costs. Because if you're writing an offer, you start checking the boxes the way you normally do, it's not going to be allowed. You just check all the costs on the buyer's side. All right? But the seller's going to love it. He's got no expense. All right? You maybe want to cut down that offer amount just a little bit because there aren't any expenses on the seller's side really of any kind. No income or credit score requirements. If the customer doesn't own any other real estate, we don't credit or income qualify them. I'm back in 2007. It's a beautiful thing. All right? So they'll fill out an application. They'll put down there what their income is. We don't verify it. All right? We don't verify it. They pull a credit report, but they don't care about score, any of that. All they're looking for is liens, judgments, foreclosures in the last 3 years, things that's going to affect title or that kind of thing, and they want to make sure they haven't had a foreclosure on a government loan or something like that in the last 3 years. But they literally don't credit or income qualify them if they don't have any other real estate, which makes it rather easy for most people to qualify. The government says in January that they were going to start making people credit and income qualify. That was last January. They're late. It still hasn't happened. I'm not sure now it's ever going to happen. They had a change of the guard at HUD, and I don't think they look at it the same way. And I just put that in there. At some point they might make people start to credit and income qualify. But how hard is it to get some people to income qualify for property taxes and homeowners insurance? All right? There's no payment. All right? So they just want to make sure that they've got the ability to be able to obviously handle that obligation and anything else that they've got out there. And from what I've heard, I haven't seen them for sure because it's not official, it's supposed to be fairly lenient if it does happen. Okay. How does it work on a purchase? All right. Loan amounts based on age, value of the house, FHA limits, and what the interest rates are. And there's basically just a formula. And a rule of thumb that I like to use is basically 50% down. All right? Somebody that's 62, maybe they're going to be like 52% down. Somebody at 70, they're going to be about 50 or 49% down. Somebody at 80, maybe down closer to 45, 44, 43%. The older you get, the less you have to put down, because all of these loans are done over an amortization with the expectation that the customer is going to live to be 100. All right? That's what's done. That's how it's expected, is that they're going to live to be 100 years old. And so that is basically how the amortization schedules are figured. And like I said, based on age is the main thing. So age and down payment are really just what it works out to be as far as a matrix, and there's just a formula that figures that. Down payment required is the sales price minus the loan amount and the closing cost. And that 50% typically includes the closing cost, by the way. All right, that's not like down payment and then the closing costs are extra. That 50% number I use is down payment and closing costs together. Okay, is what that number typically works out to be. No payment is required as long as the buyer lives in the home. Okay? They do have to pay their property taxes and their homeowners insurance and their HOAs, and they do have to have general upkeep of the property. You know the old saying, if you want to get somebody excited, skip a couple payments on your property taxes or your homeowners insurance, and the lender's going to get excited, and they will foreclose for that. So it is important that they still keep those things current. And unfortunately, some don't. But I don't know what to say about that. They understand that going in, and it's very clear in the counseling what's required. Any questions on that? Yes.
So, if someone has this loan and they pass away, their children have 12 months to sell the home if there's equity in it.
Correct.
Before the bank forecloses.
Correct.
Is that correct?
Yes. Yeah, the bank doesn't want to foreclose and take the grandparents' house. They would rather not. And so if the heirs of the estate contact the bank, say they've passed away, they're planning on selling the property, they will give them ample time to do that. They just want to know that they're working on it. They don't want to have to foreclose. They would much rather just get a real estate agent involved and sell the property, and hopefully there's some equity left over for the heirs, which is perfectly fine. The estate has the option of buying the property. You know, if there's, you know, $100,000 owed and it's worth $200,000, all the estate has to do is pay off the loan. They can either sell the property and pay it off. If there's other assets in the estate, they can pay it off. There's a number of things that they can do. If it's close, well, even if it's upside down, well, if it's close, they have the option of buying it for 95% of appraised value. Okay, that's kind of the number that they use. That answer your question?
Yes, thanks.
Any other questions? When do you have to pay it back? When you sell the property, you know, there's a lien on it, just like any other loan, so understandably when you sell it, that's going to have to be paid off to have clear title. When you stop residing in the property for 12 months. When the last owner on the loan, on title, is deceased, or if they stop paying their property taxes and their homeowner's insurance. Those are the normal scenarios of when that loan is due and payable. Yes?
If the person that takes out the loan decides to sell it, what do they pay back? Is it the 95% of the appraised value, or what? How would they know what they would have to?
Well, they'll call the lender and get a payoff, so that they can see what that balance is in relation to what the current market value is.
Okay.
So that the estate can figure out, you know, the heirs can figure out what they want to do with the property. I mean, under a worst case scenario, if nobody wants it and there's no equity in it, they could just sign it over to the bank and be done. And that does happen. That does happen. And we'll go over some amortization schedules in a little while and kind of show some different scenarios so you can see in writing how that works. Okay? Any other questions? All right. Here are some interesting numbers that I saw. Of course, it's from AARP, so it must be true, right? 95% of people who took out a reverse mortgage said it partially or fully met their needs, had a positive impact on their lives, reported a greater peace of mind, and described having a much more comfortable lifestyle. All right, and anytime you're up around 90% for an approval rate when somebody's taken out a loan, that's exceptionally high. I can almost tell you nobody's going to have that with any other loan right now, just because of the guidelines and what it takes to get them through it. But as a general rule, when you've got 90% plus approval rating on a loan, that's pretty strong. That's a very positive, I think, a very positive number. How to use it for financial planning. I taught a class a couple of weeks ago. I have a CE class approved for financial planners too, and I had a room full of financial planners. And I hate to say this, but I think the only group of people who knows less about reverse mortgages than real estate agents is financial planners. They didn't really have any concept of how it would work along these lines, which I think is very unfortunate, needs to be changed, because it's a critical component. What aspect of somebody's retirement and what asset is more important than their house? Everybody needs a place to live and has to have a way to be able to manage that asset accordingly. And of course, it used to be, the idea was, of course, everybody wanted their house paid off. But because of 2008 and you know, the financial meltdown and the Great Recession, there's a significant number of people out there that are behind, you know, because of what happened economically. And so instead of having it paid off, what a reverse mortgage does, it provides them an instrument now to where they can just get it paid to half. And they end up in the same place, which is no payment during their retirement, which is what everybody wants. Okay? So this is a gentleman I closed last year. Did a little financial planning for him, and he had 3 daughters, and they grew up and moved away. And so he had this large house that he didn't want anymore, and he wanted to downsize to a house that was more comfortable for him, that he could live in his retirement. And he was 55 years of age. And he was an Oriental guy, and he said, you know, Curtis, I'm 55, I want to put 20% down. He says, I don't know how I'm ever going to pay this off by the time I want to retire. And I said, you know, Ken, when do you want to retire? And he said, 62. And I said, and you're 55? And I said, so you can't pay this house off in 7 years? And he's like, there's no way, and most people can't. We've all seen clients in their 50s and 60s taking out 30-year loans, and we're going, really? And they know themselves, or in the back of their mind, they're all thinking, how am I going to pay for this when I retire or during my retirement? Because who wants to make a mortgage payment on Social Security or whatever they have? And this is the answer. All right, so he bought a $200,000 house, and he put 20% down. And instead of putting it on a 30-year loan, we put it on a 20-year loan. And I amortized it out so that when he turns 62, he will owe about $120,000 on it. Well, a $200,000 house with 3% appreciation in about 7 years is going to be worth about $235,000. And guess what? He's at half. And that's the magic number. So the plan is, and I'm hoping that it's not 3%, it's 4 or 5, but 3% is pretty conservative. The industry standard is 4%. Historically, nationally, 4% is kind of the given that is a safe appreciation factor for real estate over the long term, and I think that's a reasonable number. I backed it off and used 3, just to even be a little bit more conservative in this particular scenario. And so the key here, 50% equity, we have a plan in place. And I said, well actually I've got him in my database, but I said, Ken, would you call me when you turn 62? And he's like, you can count on it. Like the day. You are going to be my best birthday present ever. Because we're going to see where he's at. I know where he's going to be as far as the balance. That's a given. That's a mathematical given based on the amortization schedule. All right. So what we're going to do is we're going to see where his appreciation is at, and hopefully he's had 3 to 4% appreciation. And we're going to do a reverse mortgage. He's going to retire at age 62, and he can live in that house happily ever after with no mortgage payments. All right? What a beautiful thing. Why aren't people doing this? All right? And so anybody that you know that is buying real estate in their 50s needs to at least have this discussion. All right? All financial planners do is have a plan. Most of it is a plan. What's your plan? And obviously the earlier you get started, the better off you are. You know, time, value, and money is how it is, and a lot of it is just math and planning and time. Get started in your early 50s instead of 55, it makes it that much easier. All right? But instead, if you put it on a 30-year loan, if you can put it on a 20, even if you're in your mid-50s with normal appreciation, you're probably going to be able to make it. I have some clients, they're close, they can bring in the money. I've got one client right now, the house is worth about $185 and they owe about $130. And they're older, and so the loan amount is about that they can get is about $100. All right, well they're about $35,000 short. And they're paying over $1,000 a month principal and interest trying to beat that loan down. All right, and they're in their 70s. Trying to pay their mortgage off, and I see it all the time. And so they went, they came in and saw me, and I said, they were trying to figure this out, and it's obviously a big step for somebody when you're doing something like that. And I says, let's make it simple. Would you rather pay $35,000 down and not have a payment, or would you rather pay $135,000 down and not have a payment? It's totally up to you. It's fairly simple math. Guess what? They're going to bring in $35,000 and get rid of their payment. And they're going to take that $1,000 a month and they're going to go have fun with it. Why wouldn't they do that? And they talk to their kids and they're like, why haven't you done this already? So the key here is, as part of people's financial planning and retirement, they just need to understand that they don't have to have their house paid off in order to be able to get the end result that everybody wants, which is no mortgage payment during their retirement. And the only thing better than having a paid off house is having it half. Questions on that scenario? All right. Pretty easy math, easy amortization schedule. Works out great for people, but they need to understand the concept. And don't get me wrong, the people out there that when they turn 62 have $1 million in the bank and their home is paid off, good news. They don't need this loan. guess what? Some of us are running a little short. All right? So for the people that run a little short and they're trying to figure out because of 2008 or whatever has happened in life, how they can get to the point of being able to enjoy their retirement without a mortgage payment, this is very often the answer for them. Okay? Question?
Okay, they live there, it's paid off, they get sick, they spent all their money, and go on Medicaid. Medicaid pays X amount of dollars over the next few years while they live at home.
Uh-huh.
Sometimes Medicaid wants part of that house, don't they? So how does that work in here?
Well, I have some slides coming up on if you have a house paid off, the income producing options on it. So let's defer to that. That question is coming up.
Okay.
And we're going to talk. And I have to tell you right now, and I'll say it again, I am not a Medicare specialist.
Right, no,
All right, I can barely do these loans and be able to do that. All right, and explain them. But that can be a concern. But most of the time, what I can tell you, well, we'll just answer it now. Most of the time, what they're concerned about is money in the bank. Total assets.
$2,000 or less.
Right. Well, so the key is, if you're taking out in a monthly income, you just make sure that money doesn't stay in the bank very long, right? Or if you're drawing it out as a line of credit, you cut the check and make sure it doesn't go in the bank. It goes where it needs to go. So the key is, I believe, yeah, you just can't have over what, $2,500 or $2,000 in liquid assets in the bank. So I don't think they're after your house. They're after liquid assets, correct?
No,
They're after your house.
they're after the house when we die.
If you die.
Yeah.
Right, right, but I'm talking while you're alive. And so, and my best answer to that is consult somebody that knows when you get to that point. Because I'm not, and I'll be the first to admit, I'm not a Social Security or a Medicaid expert. Okay? All right, let's talk about, you've got a big handout and a little handout. The one that's 3 pages long that has the amortization schedule on it. If you would pull that out, and we're going to talk about purchase mechanics on how this loan works. Because when the government sends me the short version on this loan that's only 51 pages long, this is the first page that I pull out. And people kind of snicker when they say 50 pages. When actually they bring me their counseling certificate and I actually print out the actual origination package, it's 253 pages long. All right? Welcome to the government loan. All right? And so, on all scenarios, this is part of what's provided. And what this is an amortization schedule and kind of a one-page life of loan explanation of all of the mechanics that goes on in a loan. All right? And this happens to be a client that I have going on right now. I think she's going to close next week. And she owned a $150,000 house in Payette. Paid off, lived there a long time, husband passed away, moving to Boise to live near family. So her house is supposed to close tomorrow, and she's going to net about $140,000 out of the sale of this house. And her agent went to a previous class, and she wanted to buy a house at about the same price, around $150,000 in Boise. And he said, well, you can pay cash for it and not have a payment, or you can take a reverse mortgage out and put down half and have the other half available. So she came and saw me, went through the counseling, and she's going to close next week on this exact scenario. All right? And she's 66 years old, buying a $150,000 house. And her cash due at closing is $78,800, just over half. All right, it's like 52% down. All right, so out of that $150,000, $40,000 that she's going to net out of her sale of her other house that is paid off, she's going to put roughly $78,000 down on the new purchase, but she gets to keep the rest. And she's excited. She's got plans. She's going to travel. She's going to get a car. She's got some money in the bank. She's excited because she's going to move near family, and she's got money that she never had. All right, because it was tied up in her house. So she's going to put half down. buy a much nicer house in Boise than what she had in Payette, be right near her family, and have money in the bank and liquidity that she didn't have otherwise. All right? She gets it. And she's excited because she's so much better off with her move than, and well, I'd like to say she's better off in Boise than Payette anyway, but between all of this coming on, she's way, way ahead. All right? Financially, to end up in the same place. And she's 66. She could potentially live in this house for 35 years and never make a payment on it. She likes it. All right? And on the expected appreciation, 4%. All right? Age, down the left-hand column of the loan. Mortgage insurance. All right? Mortgage insurance accrues on these loans. And it's based on 1.25% yearly. So a $100,000 loan, roughly $1,125 is going to grow on that loan every year. There's your mortgage insurance. Interest rate on this one is fixed. Here is your interest that accrues. Notice your loan balance goes up. Guess what? This is very basic math. You're either making payments and your balance goes down, or you're not making payments and your balance goes up. That's all there is to it. All right? So on these loans, your balance does go up. Okay? It's how the math on them works. What I want you to notice, though, is loan balance at the end of year one, $86,000. It started off at $81,900, $86,000, $91,000, $97,000, and how that balance grows is a combination of the mortgage insurance and the interest. So you take the mortgage insurance plus the interest, gets added to the balance, and that's how your balance grows every year. All right? And it goes up by that amount. This goes out for 15 years. What I want you to notice is, at 4% appreciation, notice what happens to her equity position. For the sake of conversation, it stays the same. All right? As your balance grows, your value's going up. The equity position stays the same. So notice here that she's not losing any equity if it stays at around 3 to 4% a year. All right? So she can sell this house down here 15 years later under a normal scenario and get that money back that she put down. And she had no payments in the 15 years in between. Why aren't people doing this? You know why? Because they don't know that they can. When I present this to people on a purchase side at 62, a surprising number of them are more than willing to do this because they can keep 50% of the money and do something else with it tangible. As I said, if nothing else, there's nothing better than money in the bank. Any questions on that? All right, so in the first half of the class, we kind of went over the purchase side of things. Do you have any other questions that I can answer initially on the purchase side? Because then after that, you need to roll and change your hats to the refinance side because it's a whole different perception. Yes?
Is there a chart somewhere for a person's age and how much money they're going to have to put down? Like, if you're 62, it's 50%. What if you're 80?
It's like 45. It's close enough. You just use half.
Okay,
Just use half.
It might be less, but it would be
right,
more.
I use half because it's fairly safe. And when we order that grid and that initial short 50 pages, we get their birth date and like their equity position or their purchase price so that we can provide that early. And it's going to get it pretty close at that time because otherwise it's hard to guess.
All right.
So I just tell them to expect half and then sometimes pleasantly surprised because it's a little bit left. Yes.
So do both, on the purchase, both borrowers have to be over 62, or if it's a husband and a wife, just one have to be over 62?
Just one, and we're going to talk, we might as well just talk about that next. Is that what your question was?
No, mine.
We'll get back to you on that.
Oh, another property.
Yes, ma'am.
Your interest and your closing costs, and are those tax deductible?
I don't know. That's a CPA question. I believe on a purchase it probably is because you're paying them up front. But on a refinance, it's probably not because you're not. But that would be something to ask a tax accountant to know for sure. On the husband and wife scenario, because this is important, it was one of the reasons that unfortunately reverse mortgages have kind of a bad reputation. In the old days, which was before August of 2014, 45 days ago, all right, if the husband, and I'll use a husband and wife scenario, which is typically what happened, if the husband was 62 and the wife was 59, she could not be on it. And so the husband takes out the loan. And unfortunately, within a year or two, he passes away. Because she was not on it, the loan was due and payable in full. All right? And unfortunately, if 2008 happened, the world collapsed, they were upside down, HUD foreclosed. And unfortunately, they foreclosed on the widow and took the house. And there was some bad press on that. And believe it or not, HUD finally got tired of getting sued. And they changed that in August. And now, if there's somebody over 62 and somebody under, they still can't be on the loan if they're under 62, but they've rolled out a set of guidelines so that they don't have to move or sell the house. And it is, they have to still be present for the counseling. I believe they have to sign like the note and the deed of trust. And there's a couple of other things that need to be done, but they now have a fairly easy set of requirements so that, and they go off the loan to value off of the younger spouse, not the older. So it's also more conservative with the expectation that if she's 59 and going to live to 100, they back that off a little bit more. So they back the loan to value off a little bit more with the understanding that then she can stay. So now that has changed, thankfully, because that was one of the tough parts if you had somebody over and somebody under. Ideally, of course, you've just got both that are 62. But if you have one that's over and one that's under, now at least there's a mechanism so that the one that's under 62, if the older one passes away, that they can still stay in the house.
Is there any minimum age for the younger spouse? Could you have a 35-year-old?
You can have a 35-year-old.
Good
luck with that.
I have a friend that wants to know.
Sure. Other questions? Yes, ma'am.
If both people are at 62 or above, do they take it from the oldest person or the youngest person?
Always the youngest.
Okay.
Yeah, they take it from, believe it or not, they take it from the youngest borrower, the most conservative,
Okay.
when they do it. Yes?
And you mentioned that if you owned other properties.
It's perfectly allowable to own other properties. However, if you, on a refinance, they don't make you credit or income qualify at all. Because they figure you've already, there's no payment being added and you're already paying the taxes and insurance, is I believe the logic. So you don't have to credit or income qualify currently on a refinance, but on a purchase, if you own other real estate, they will make you credit and income qualify. They just want to make sure that you can handle the taxes and insurance and obligations on the property that you're buying. Is the rationale. Yes?
Are taxes and insurance set up in a reserve account, or are they privately paid by the homeowner?
On a purchase, they are not, because there's no escrow. The idea of an escrow is you're making payments every month, and there are no payments on this loan. If you're doing a refinance and drawing money out, you can actually set up a reserve so that it's paid out for 2 or 3 years. So if you draw some money out on a reverse mortgage, you can actually do a set-aside to take care of your property taxes and homeowner's insurance for a while, which is helpful. I actually have a client doing that right now. All right. Any other questions on the purchase side? All right. So we're going to set the purchase side over here. All right. Now we're rolling to the refinance side. These people already own the house. Okay, that's the important part here mentally, because I have people struggle with this transition. So we're now going to the refinance side, and these people already own their home, and we're gonna explore what options these people have when they're already a homeowner. All right, and on a refinance, your advantages are, my favorite: eliminate your mortgage payment forever, pay off outstanding debts, converts an illiquid asset to an asset, provides a controllable monthly income for life or a shorter period of time, preserves other assets. All right? Who wants to draw money out of their retirement account and have to pay taxes on it if you don't have to and it's growing and making you money? Shouldn't that be what you're drawing on last and not first? Mitigate spend-down risk, we just said the same thing. Can protect the home and the estate. Unfortunately, if somebody is involved in a bankruptcy or a lawsuit or that kind of thing, a paid-off house is one of the first things that a creditor is going to go after. However, if you've got it mortgaged and you've got an exemption on it as well, suddenly it's not an asset that's nearly as desirable for somebody to go after. Manage longevity risk. We're living longer. If somebody lives into their 80s and 90s, what are the chances they might spend their retirement accounts? This is an asset that they may be able to tap on for life so that they've got a stable monthly income besides Social Security. It's tax-free. So the only loan that's better than a loan you never have to pay back as long as you live is one that's tax-free too. You win on both ends on this deal, all right? So it mitigates your tax consequences as well that you don't have if you're drawing out retirement accounts. Yes?
We talked about the minimum age that you can be 62. Is there an upper age limit for taking up?
150. That's when the note's due and payable. All right? No, there's no age maximum. As long I've got a couple in Weiser right now. They're 85, and we sent they've already gone through their counseling, and they're all about it. And they're on their way right now, and they've got their 253-page packet, I believe, is getting in the mail to their house today. All right, so no, there's an age minimum, but there is no age maximum. Yes?
Still 50%, I believe.
Well, they're 85. They get a raise.
What about somebody that's not 85? Somebody that's younger?
Well, it's based on age, so the older you are, the more money you get on a refinance. All right, is how that works.
Basically, when they're refinancing it, they're getting that money out.
Yes, and we're going to go over a whole bunch of options on how they can take that money out. All right. Here's an amortization example. I showed you one on a purchase. All right. Keep in mind this is a refinance. This is a classic example of a client that I had who just happened to be a real estate agent, and I believe it's the second full handout that you have here, and I print these out separate because they're a little bit easier to see than the smaller one. And this client was 67 years old, and he owed about $90,000 on his house, and the house came in at about $285,000 for a value, and he was tired of paying it. He was 67 years old, and he was tired, and he was close, but 90,000 or so is still quite a ways away when you're 67 trying to get it paid off. All right, so we did a reverse mortgage for him, paid off the first, put his closing costs into the loan, and set up a line of credit for the difference in his equity. Made all his dreams come true. Not only did it eliminate the mortgage payment, it also gave him a line of credit to draw on in case of emergency, and they can live in that house happily ever after with no payments. Took a huge amount of pressure off of them financially to eliminate that $1,000 a month mortgage payment. Yes?
So what if there is already a lien from a medical situation on the house? Does that have to be taken care of? Like, if that was something you wanted to
You just have to pay it off out of the proceeds.
So you could still get qualified
Yes.
for it and use that to pay back?
Yes,
Okay.
we do it all the time.
Okay.
Paying off medical bills is one of the primary reasons people are taking these out in order to take care. Hopefully they get paid off before they're a lien.
Well, like the spouse passed away, so those spouse medical bills have been liened on the
Yep.
house.
So yeah, they could draw the equity out of the house to pay those off. Yes. So on this one, notice loan balance, mortgage insurance, interest rate. Notice your interest. Notice the balance is going up. But notice the equity position here. They're still gaining at 4%. All right? So they're still increasing their equity position even though they paid off the current loan. Yes?
So if they use the line of credit, is that the interest rate they pay?
Yes. And then that line of credit, if they draw on it, will drop here and roll over to here as they need it. All right? No payments. It's my favorite loan in the whole world. What other loan can you take out with no expectation that it's not due and payable until after you're deceased?
So no payments on the line of credit either?
Either. No. There's no payments on this loan ever that has to be paid back.
So weird.
That is.
It's so hard to-
that's
One of
why
those
you're
too
here.
good to be true
Yeah.
things.
You know,
Waiting
you know,
for but-
it's amazing talking to seniors because they've borrowed money for 50 or 60 years with the expectation that you got to start paying it back next month. You know, and some of them just really struggle with the idea that I'm borrowing money that I never have to pay back as long as I live.
Well, I think that we all forget the reality of what they get at the end, and so they see it as a great return.
Yes, and a stable return.
Yeah, if it's a good market.
Can you
Question?
pay off the loan? Let's say you have an inheritance and 5 years down the road you want to...
Yeah, there's no prepay on it. They can pay it off anytime. Same way if they decide to sell the house and move. I've had one customer, they had a current reverse mortgage. They decided the house didn't work anymore. They sold the house and took the other equity and went and took out another. You can only understand they only have one at a time because it's primary residence only. But you can sell the house or pay off the property and keep what equity is there at any time that you want.
Has that ever caused a problem with how the loan grows when they're trying, you know, they've increased the interest in so the balance has grown, so when they go to sell it or pay it off, does it end up with them being in a bad position?
Well, under a worst case scenario, you're saying what happens if they're upside down? That's what I hear you asking, right?
Yes.
Well, it's a non-recourse loan. What's the worst thing that can happen? They walk away. The worst thing is you walk away. It's not a foreclosure. It's a non-recourse loan. It doesn't go against their credit. They can just go take out another one. All right? So, yeah, it's not like a negative credit situation. How can you have a negative credit situation on a loan you don't have to pay back? All right? Question?
What about the appraisals? Are you going to talk about that a little later?
Well, just that it's an FHA appraisal. It's
So is
a
it an actual appraisal?
actual FHA
It's not a
appraisal.
system?
No, no, it's an actual FHA, boots on the ground appraisal. All right? That is what it is. It's, yes.
Would you have to deed the property back, like a deed of foreclosure, or how would...
Well, the bank would probably prefer that you deeded it over, but you could just, in theory, walk away and have them foreclose. You know, that's all they can do. Yes?
Okay, what about the heirs then, when they do decease, and the family gets the house, if there is still equity, they just sell it?
They just sell it and keep it.
Okay, so the bank, do they have say in what happens?
No, they do not.
They do
As long
not.
as they have say in that, yeah, you have to pay us off.
Okay,
Within
That's
12
it.
months, right?
Yeah, ideally, and they might even give you an extension. They just want to know you're working on it and that you're trying to sell the property and pay them off. Okay?
Cool.
Any questions on this scenario? This is one of the most common, which is eliminate the mortgage payment. All right? Yes.
You said it has to be their primary residence. What if 10 years down the road they decide they want to go to Florida and rent out the property?
You can't. It's due and pay. If you move out, it's due and payable. It has to be your primary residence. However, the rule says you have to live in the house 183 days a year. All right? It's perfectly fine to have a second home. And I'm not sure how they'll count the days, but that's the rule. Is that, so no, you can't rent it out. You would at that point either want to sell it or refinance it and get a regular loan, you know, investment property loan or something. But you have to at least live in this property 183 days a year. It's an owner-occupied primary residence loan.
And for those creative clients who try to declare two primary residents, the IRS is going to be tracking, right?
Somebody's going to get excited. Somebody's going to get excited if you have two primaries. It will somehow, I would say, catch up to you eventually. Yes. All right. Closing costs. All right. That's the other thing you hear is, oh my gosh, these loans are so expensive, and in my opinion, they're not that expensive. All right. Some people think they are, and some people think they're not. But my question is, how expensive should a loan be on a loan that you never have to pay back?
Yeah.
All right, what is that worth? What is that worth to take out a loan that you don't have to pay back as long as you live? Should it maybe have to cost just a tad extra? Maybe just a little bit extra than a, you know, would you rather take this loan out with a little higher closing costs and not pay it back? Or would you rather take out a lower loan with closing costs and pay it for the next 30 years? It's strictly up to you. I don't know what else to say. It's just almost that clear. Okay? And so on the closing costs, the origination fee is 2%. And it's 2% of the appraised value, not the loan amount. Okay? Up to a $6,000 maximum. After that, so up to a $300,000 appraised value, it's 2% of the appraised value. After that, it doesn't matter. It's just $6,000. Minimum is $2,500. And then you've got your normal closing, escrow, title insurance, that kind of thing. The other thing that is expensive, and what's most expensive on a reverse mortgage, we mentioned the mortgage insurance, the PMI, MIP. It's 2.5% upfront. They have an upfront fee of 2.5%. That's why they're almost about double, is because of that mortgage insurance that's charged up front. All right. And then it's 1.25% annually based on the balance. Yes?
Is the mortgage insurance based on the loan amount or the appraisal?
The loan amount.
Okay.
Yeah, it accrues based on the loan amount. Sir?
Two borrowers, or two cohabitators, both over 62.
Yeah, that's fine.
You can get two different houses.
No, well,
two private.
as long as they don't live there, as long as they're both living happily ever after separate.
183 days a year in each house.
So who has that off day? We'll just leave it at that. Sir?
Can you load some of the costs into the interest rate?
Yes. You can raise the interest rate and often take care of the origination fee in it. So it's like 4.5% with an origination fee or 5% without, which on a purchase often is helpful because let's face it, if you put that origination fee into the rate on a loan you never have to pay back and it lowers your cash to close, guess what? Most buyers don't care. Okay? So this is an example of the closing costs on the loan I mentioned earlier. And so the closing costs were a little bit higher. They got rolled into the loan. All right, you got to keep in mind on a refinance, they're not out of pocket. I have a son, his name is Noah. He's 17 years old. And I tell him constantly, my goal in life is to be a burden to my children. All right, and I say, you are going to take care of me when I retire. And he's like, yeah, right. And I told him a while back, because he was back talking to me, I said, quid pro quo, son, I'm going to live long enough, you're going to be changing my diapers. And you should have seen the horror in that 17-year-old's eyes. All right? But the point is, on a refinance, it's not something that's out of pocket for the client. The estate is paying it. The future heirs are paying it. Their equity is paying it. The buyer, the client, isn't paying it. And conceptually, that's one of the things that's so difficult for people to try and understand with the closing costs, is they'll see that, this $15,000 number and see, my gosh, that's too expensive. And I'm like, really? You're not writing a check. It's not coming out of any of your accounts. Your retirement is paying for that. Thank you. Why don't you enjoy it? And that's conceptually one of the hardest things that people have understanding with this loan, is that on a refinance, your equity is paying for the benefits of it, which is okay. And I'm like, so when I die, and my estate sells that property, and Noah doesn't get quite as much as he thought, you know what? That's just too bad. He's on his own here shortly anyway.
That's why they go to counseling with you.
That's part of it. There you go.
They're going to forget.
Thank you.
They're going to forget at that time.
Thank you so much.
But that's why they're supposed to go to counseling.
And that's one of the biggest objections I have with taking one of these out, is people say, what about my kids? And my answer is, what about you? All right? This isn't about them anymore. This is about you. This is about your retirement. It shouldn't, they're 62 years of age. Typically these kids are in their 30s and 40s. Somewhere along the line, shouldn't they maybe start to grow up? Could it maybe, once you're in your 60s, start to be about you again and not about the kids anymore. We're talking about their retirement. Not the kids' retirement. It's about how can we have people retire and be comfortable and have a good quality of life well into their retirement and not have to worry about finances. And that's what this does. That's what this loan instrument is for, is so people can have a comfortable, secure retirement under a number of different circumstances, so that in this case, Noah doesn't have to worry about supporting me quite as much, because I can take out a reverse mortgage and not have payments to worry about. Okay? Disbursement options. On a refinance, there are actually 6 different ways that you can draw the money out. Alright, and we're just going to hit on some of them, but I'm going to go over the 3 major ones which are most important for people when they understand it. The first one is lump sum. And normally when you're drawing out a lump sum, it's to pay off a mortgage. You know, you're taking out that lump sum, you're just trying to get rid of that mortgage payment so that you can live happily ever after in that house and not have to worry about making payments anymore. And occasionally somebody will have a large expense that they have a paid off house or close to it, and they've got a large expense that they have to take out that they might have to do a lump sum. But most of the time behind a lump sum is to get rid of that mortgage. Alright? 10-year payments. That's a monthly income for life, is what that means. Based on age and equity and that kind of thing, there's a formula there that they will take out, and they will say, based on a $200,000 house and being at 75 years of age, you can take $700 a month out for the rest of your life, is an example of about what it is. Well, you know what? For somebody on $1,100 or $1,200 a month Social Security, that's a really nice raise. And that's a lifetime guaranteed income into their account every month, just like Social Security. Alright? So why wouldn't you do that if you need the money? Line of credit. This is my favorite. We're going to spend a little bit more time on that. And that's where you set up a line of credit that you can draw on at any increment, at any time, for any need. Structured payments. Instead of doing it for a lifetime, let's say the common one is Social Security. They're 65 and they retire, and they don't want to start drawing Social Security at 65 because you almost get a 50% raise on Social Security if you wait until you're 70. So why don't you either take out a line of credit or a structured payment so that you don't have to draw on your Social Security until you're 70, and you can live off of your line of credit or your monthly income on your mortgage, so that when you start Social Security, you get a much larger monthly disbursement. And that's actually a really common financial plan if you do it right. You can also do virtually any combination of those. Pay off part of a mortgage like the one we saw earlier, paid off his mortgage and set up a line of credit for the difference in the equity. Or pay off a mortgage and a monthly income stream. Almost any reasonable scenario for people, if they have the equity, depending on what their circumstances are, can be accommodated with this loan. Assisted living, in-home care. Let's say they need $2,000 because of health issues. Well, just set up $2,000 a month that goes into your account every month for as long as it lasts, and your in-home care is taken care of. And you don't have to draw down your other financial assets. Or worse, ask Noah or your kids to pay for it because you don't have any other money. We talked about lump sum, lifetime payments, term payments, certain period of time. Line of credit. This is my favorite option for somebody with a paid off house, or somebody who nearly has a paid off house, because it leaves so many options available to them. Okay? And on that, when it's set up, you can draw on it for any reason that you want. People can draw on it and buy a motorhome and ride off into the sunset for 182 days a year if they want. Alright? Medical bills, assets, anything they want to buy, second homes, annuities, any of those kind of things. There are no restrictions on a line of credit for what you use the money for. It has a growth rate that I'll explain in a minute. But remember, we talked about the interest rate and the mortgage insurance? if you don't use the line of credit, that's how much it grows each year, which on an average right now is 6%. And I'll show you a grid here in a minute, which can be a life-changing event for people on doing financial planning with a paid-off house, using that growth factor for their future years and their retirement planning. The growth factor. This is what I mentioned about how it works. And I like using, and there's a slide here coming up, on a $200,000 house, and with their age, they had, after the closing costs, exactly a $100,000 line of credit. And I like that number because it makes the numbers very easy for people to see and understand. And for a lot of people, a $200,000 house is a reasonable value in this day and age that they can do. And so here's your formula. It's the interest plus the mortgage insurance, and it's figured monthly. All right? And so literally, the mortgage insurance and the interest grows on that line of credit at a monthly rate. So 5% interest, 1 1/4 on the mortgage insurance, 6 1/4% a year is what that line of credit grows at. Try and get that in a regular investment, by the way, guaranteed. $100,000 amount, $520 a month. It's actually more than that. That's a simplified version that I'll show you. But for the sake of that, that's how much it grows every month. It's not an annual thing, it's a monthly thing. And it grows based on whatever the balance of the line of credit is. So if you draw a part of the line of credit out, it continues to grow on the part that's unused. So on the unused portion, the line of credit continues to grow. All right? At the end of the first year, look at what the balance is. It's actually compounding. This is my favorite grid on this line of credit. It's one of your 3 pages, if everybody could go to that.
Is there a time frame on that? Do you have to wait so long before you can start withdrawing?
No. You can take it out and start drawing on it right away. Now, they don't like you to draw it all at once. Last year they changed it and they said if you take out a line of credit, you can only draw out about half of it in the first year. And then after year 1, you can draw out the rest. So they put somewhat of a limitation on it because people were taking the line of credit out and then they were drawing it all out right away. And it didn't leave them any. So the government, in their infinite wisdom, decided that they had better go ahead and put somewhat of a restriction. So you get a little over half in 12 months and then you can get the rest after a year. It is the way that that is set up. So on this growth factor, 65 years old, 5% interest rate, $108,000 was what it was. Closing costs were rolled into it. So the line of credit is $100,000 with a 4% average appreciation rate based on the house. However, I want you to know, on this growth rate, it doesn't matter what the value of the house is. So you could take this out as based on a value of $200,000. And next year, we could have another 2008, and the real estate market could collapse. It has no impact on this growth factor whatsoever. It will continue to grow at the agreed rate regardless of the home's value. All right? And I have people say, well, I think I'll just wait and take it out later. And I'm like, that's all fine and good. If that $200,000 house that you can do this on now is worth $150,000 or $100,000 to 5 years from now, because unfortunately we have another bad drop in the market, I'm not sure what you saved when it's growing based on a 6% appreciation rate. All right, which is something that I tell people to keep in mind because you always have those people that think it's better to wait, and that's okay. But I'm not sure in this case that time is on their side. And so, 65-year-old, $100,000 line of credit. And notice when you take that line of credit out, the only balance we have here is just the closing costs. That's all that was taken out, was just the closing costs. And you can't pay this off, but you can pay it down to $1,000. If you pay it off, it closes it. All right? But you can pay it down to like $1,000. So if you want to take this loan out and your closing costs were $8,000, you could pay it down to $1,000 and just let it sit there. It's not accruing interest, it's not accruing anything of any consequence on that small amount. But look what it does to the balance. All right, look what happens to this balance. In year 5, it's $136,000. In year 10, it's $186,000. So you turn 65, your house is paid off. You choose to retire. You take this line of credit out and you just let it sit. What a great hedge against life. All right? You can sit there and know if you just live and take care of life that in 10 years when you suddenly need in-home health care or some kind of assisted living assistance or help with medical bills, that you have a $186,000 line of credit that you can draw on for anything that you want, and you don't have to worry about drawing down or spending your other assets. All right? Why wouldn't somebody that's retired and has their house paid off, why wouldn't you just take this out and let it sit? I mean, what a nice form of insurance against, you know, those bad things, or maybe those good things that happen in life. You know, you could take this out and buy a second home with it, or put a large down payment on it for a second home, and guess what? You've got no payments on either one. Yes?
So suppose in year number 10 that the homeowner passes and the family then is looking at the piece of property. So do they then have $186,800 of line of credit that they can have?
No.
Okay.
It closes upon death.
Okay.
But on year 10, the balance on the loan is $15,000.
Oh, I see, okay.
So there's a debt or a lien on the property of $15,000 that either they can pay off out of the estate or just pay it off when they sell the house.
Okay.
Okay? So no, you know, but look at 4% appreciation on year 10, that house is worth $280,000.
Okay.
All right? So they've got a $280,000 asset there with a very small balance on it. All right? See, this is Noah's savior if I get my house paid off, because I'll draw on this first rather than having him pay me monthly. All right? Because that's the other option that he has. I'm going to, you know, he's a junior at Bishop Kelly, and, you know, we're going to get him through college, and he doesn't realize it yet, but, you know, financially, if I don't get this done, he may be one of my best sources of income. And so this is a nice way for people whose home is paid off or have a lot of equity in it to either finish paying it off or to set up a line of credit so that when they need help in the future, they've got something to draw on, and they don't have to drain their IRAs, they don't have to drain their 401ks, they don't have to go after their kids or need to have their kids help them monthly because they've got this large financial asset. This is just like money in the bank, folks. It's just exactly like a line of credit or a money in the bank that you can draw on for anything you need. Yes? Question?
Okay, I think we talked about this, but I'm not clear about it. So when they decease, then the bank isn't right there saying, you got to get this house sold.
No.
So what's the time frame
They like to be notified within 90 days
of the death?
of the death, and they would like within the next 90 days to have a plan.
Okay, not necessarily sold.
No, no. They just
So
want to
they're
know
not
that
gonna-
the estate or the heirs or somebody is working on getting them paid off.
Because I think that's where the misconception is. A lot of people hear, well, as soon as they die, they're going to be there right there. The house goes to the bank.
No. First of
And
all,
that's
keep
not
in
so.
mind that the client, the customer, the people are still on title.
Right.
All right? It's still their house. You know, under a worst case scenario, they've got to go through foreclosure. That at a minimum takes 6 months.
Right.
And I can assure you, they don't want to foreclose. All right? The government's had enough bad press. The last thing they need is any more with this kind of thing. And so, you know, the heirs in the estate need to understand the mechanics and the steps. And that's part of the reason why the counseling is so important. And I really think it's important, if the children are local or whatever, that the kids are involved so that they understand how it works. And when I'm working with clients, I If they're local, I encourage them to bring their kids with them to the appointments and to the counseling, because in the end, you know, in theory, when the kids are handling their estate later, it's important that they understand the steps that are necessary so that, you know, HUD, FHA doesn't get excited because they don't have communication. Yes?
On your scenario there, like year 10, if I'm reading this right, if you have a credit line of $186,000 and you owe $15,000, can you pull that all out, write a check to the bank for the $15,000 and in essence paid off your loan?
No, because you're borrowing money to pay off money. You can't. No, this is money owed. And the problem is, if you take money out of here to pay off this, you've just swapped it. It's still a lien. This is still a debt. This is still a line of credit. So no, you're just spinning your wheels by doing that. You would want to pay that off with something that is not off of this line of credit. Because anything that you draw on this line of credit ends up over here on your loan balance. Good question. But no, you would want to pay that off from something that did not come out of that line of credit side if you wanted to pay it down or pay it off.
But am I correct? Could you just, if you had $15,000, could you just pay that loan off then, and that would be your payout? Or
Yes. Yeah. Correct. Yeah, that's all it is. Now, keep in mind, if you pay it off, it closes it. Now, if they've passed away and you're settling the estate, that's what you want to do, because then they're out of the picture and you can do whatever you want with the house. However, if they're alive and they're moving into assisted living or whatever, you know, depending on what the circumstances are, you may want to pay it down or pay it off, depending on what the issue is. Okay? I think this is a great retirement strategy for people who have actually got their home paid off. I really think it's a good strategy, because if they take this line of credit out, they haven't hurt anything. The balance is so small, it's going to have a very negligible impact on their estate. But if they need money, they need help, what a great thing to draw on, especially if they've lived long enough that they may have exhausted all of their other retirement accounts. This will always be there. And that's up to the individuals. I would argue that, you know, is this something you draw on as a first resort or a last resort? It kind of depends on your outlook of things. And I hear all the time, well, Dave Ramsey says these are bad. Well, you know, Dave Ramsey lives in this world that everybody, when they turn 62, has $1 million in the bank and their house is paid off. All right, and if you can do that, great. As I said, you don't need this loan, but some of us are going to be running a little bit short. My favorite guy on the other side, his name is Evad Yesmar. Have you heard? Evad Yesmar says you spend every penny you ever make and you don't save any money for retirement. So you've got Dave Ramsey on one side, Evad Yesmar on the other, and by the way, Evad Yesmar is Dave Ramsey spelled backwards. All right? Most people are in the middle somewhere. Okay? A lot of people are in the middle. If you can do the Dave Ramsey thing, fantastic. You don't need this loan. Unfortunately, if you've been more of the Evad Yesmar and you've spent every penny you've ever made and the only thing you have is equity in your house, and suddenly you retire and you haven't done everything the way you wanted or should have, or life has happened, here is at least a financial strategy that might help some of those people that are behind so that they can still retire and have some semblance of a reasonable retirement. Okay? Any questions on the line of credit, growth rate, uses, that kind of thing? I've heard people say, take this out and buy a motorhome with it. Second home with it. Rental property with it. Annuities, income generating options with it. There's how many different things can you think of if you're retired and you have one of these that you could draw that money out, that you could use it in retirement either to generate income or have fun? What's the matter with being retired and taking some of that money and going having fun with it? You know, all you're doing is taking a little advance on your kids' inheritance. Whose money is it? You know, whose equity is it? It's funny how many people with IRAs and 401ks, all right? The idea of an IRA or a 401k is while you're working, you're putting money in it every month when you're working and generating income, and you're building up that IRA or that 401k, and you turn 65 whenever you retire, and then you turn around and spend it back down, right? So you build it up, and you spend it down. Well, all this is an IRA with a roof on it. Okay, that's all we did. We just put a roof on their retirement account. Why can't you do the same thing with your house? This is how you do it with your house. You spend it down, or you put that money in it, and after you retire, you draw it back out. It's no different than any other retirement account. The only thing that is different is mentally, you have to be able to grasp that strategy, all right, that you use it like an IRA or a 401k, because you can do the exact same thing with it. All right? So, there's your 401k. If I see people all the time, you know, they retire, and the only asset they have of any significance is a paid-off house. All right? That is their primary asset, and the only thing they have monthly, typically for income, is a small pension and or Social Security. And unfortunately, so they've retired, and at the end of the month, you know, they can't hardly pay attention. All right? And that's just wrong. All right? When you could either set this up or draw it up on a lifetime monthly payment and take that extra $500, $600, $700 a month and go have some fun with it. I mean, I have a lady right now in our office. She owes $35,000 on her house. She's into her 70s. She's really struggling financially. She's got children living with her. And our biggest struggle with doing this loan is because it's an FHA appraisal, we can't get her gas turned on because the gas company shut her gas off. All right? There's a hard luck story. I see this all the time. Right? I closed a lady a few months ago. She was 65. She's living in her parents' house. Parents passed away. She inherited the house. She had a 13% first mortgage, $80,000, 3 years behind on her property taxes, and behind on all her other bills. She did not qualify for a loan in any shape, manner, or form, and we closed her on a reverse. Paid off the mortgage, brought her property taxes current, gave her a check at closing for $9,000, and made all her dreams come true. Right, so I have one more question on the line of credit growth rate that I want to explain. The line of credit sits there, all right, and it gains at 6% a year, as we showed in this example. But keep in mind, this is a line of credit available. It's not actual money. It's money that's available to draw on if you need it. It grows, but the only balance is right here. This is the actual balance on the loan. This is what's available, but is not borrowed. You can borrow it, but it is sitting here growing, and the reason it's growing is because you have not actually borrowed the money. And so it's a line of credit that is increasing, but that is not actual money. It's just a line of credit limit that is increasing. Like, think of a credit card, and they keep raising your limit, but you don't have a balance on it. That's what this is that you've got this limit increasing, but unless you use it, if you use it, then that goes over here on your loan balance because you've actually borrowed it. Okay? Yes?
And then you're actually offsetting some of that cost with the equity growth.
Right. Because notice here what your house is doing as it grows at the 4% a year. Correct. Yes?
Coach, could you just pay those upfront closing costs and then not have a loan balance unless you took money out?
I believe they want you to have like $1,000 balance so that it's active. But you, like I said, you can pay it down to next to nothing. Next to nothing. Here's just a couple of scenarios that I often see with people wanting to downsize. And I've just put some different scenarios in here because we'll often see these things with people. You know, this gentleman wanted to downsize and retire. He had a large mortgage balance, quite a bit of equity. He netted $175,000 out of it. So he turned around and bought a $250,000 house. He put $125,000 down. He's got no payments, and he netted $50,000 to either put in an account, draw income on, or go have fun with, similar to the slide that I showed earlier. All right? And so he's able to retire. He got rid of that big $1,500 payment, moved into a really nice house, has no payment, and money in the bank. Is he ready to retire at age 62 now? He absolutely is. And he's way better off than he was if he'd have stayed in this house struggling to make a mortgage payment. creating rental income. We talked about drawing on that line of credit to buy investment property. What a great way, if you've taken out that line of credit, to put 20, 30, 40, 50% down, whatever it is, and buy investment property with it and generate an income stream for you, plus the appreciation in the rental. All right? You've got no money on the money you took out of your primary residence. All right? But you can go ahead and buy an investment property with it and generate an income stream for you as well.
So now you just solved Noah's problem of not there being anything left for him. Now there could be.
Yeah, well, I'll let him stay in the rental house. He's going to pay me rent. I like it. So this is an example of buying investment properties off of that line of credit and generating another form of income. And that's not all bad for us, you know, in the real estate business either. Yes?
Could someone do this on, say, like an RV park where you're going to live in the park in an RV and you're renting out the spaces?
No, not you.
It has to be a house?
Yes,
Okay.
yeah, a house, single-family residence, 2 to 4 units, nothing commercial.
So,
Now you could
okay.
take, yeah, it can't be anything commercial. It has to be qualified as an FHA loan.
Okay.
Okay.
But you could take the line of equity out on
Thank
the
you,
refi
and buy a
and
commercial
buy a
property.
commercial property.
Yes.
If there's a home on the RV park?
No, not that much commercial influence. It's not going to go
Okay.
FHA.
All right.
I like the concept, but no. And it's funny for the kids who object to the taking out a reverse mortgage and setting up a line of credit. You know, it's suddenly when the parents start discussing gifting money to the children. It's funny how often all those objections go away. So like if I take out one of these line of credits and say I'm going to give some money to Noah, you know what? All those objections are going to go away. And often this is a great way. If kids or grandkids need help with college or buying a house, you know, their first home, whatever it is, why wouldn't you just take a line of credit out on your own and gift that money to them to buy that house or help them through college, rather than drawing down your investment accounts and spending, you know, your cash assets in your retirement accounts? To stop and think of it. If you're gifting money to your kids, all you're doing is giving them an advance on their inheritance, and it doesn't impact you financially at all. All right? This is, in my opinion, how you should be gifting money to your kids, is taking out a line of credit and advancing that money to them that way, because all you're doing is advancing them their inheritance. And it's not drawn down your retirement accounts or 401k, and there are no payments on the money.
Isn't there government rules and laws on how much you can gift each year?
Yeah, it's right here, $14,000 a year.
That's a year?
Yes.
Okay.
But that's also husband and wife. So the wife could do it, the husband could do it, you know.
So it's per person?
Yes,
per year.
so it's per calendar year, so that's why this one you do it once in December and once in January, because it's calendar year, and that's exactly what this is set up for, is so that you can kind of get around those numbers, which is about $14,000 a year. Okay. Purchasing a second home, we talked about that. You know, if you've got your primary residence paid off, you've got a heck of an asset that you can borrow against. You know, to buy a second home and either put a large down payment on it or pay cash for it, depending on exactly what the equity position is in your primary residence. I'll bet this is your favorite slide.
This is a good class.
Final questions on the class. All right. A few things, if I may. I don't charge for phone time. You're more than welcome to call me. I realize conceptually this is a little different. That's why they call it a reverse mortgage. You know, conceptually it's a little bit different, and I know some people are looking at me going, they've got questions. Please call me or email me. I'm more than happy to help you work through those scenarios or what your questions are. I hope everybody got a CD. I hosted a television show. It's about 55 minutes long, and on that show I had a CPA financial planner with me, who also happened to have a broker's license and a master's in real estate. And we went through everything that you heard today with scenarios, so that it's something that people can watch and not have to come to class. I also have it uploaded to YouTube. If you want to, please just shoot me an email. I'm more than happy to shoot the link to you. Or if you just go to YouTube and pull up Curtis Mangus, it'll pull that right up for you. And it's a nice way for people to just click the button and watch it. And it gives them a nice, easy way that they can sit there in about 55 minutes and learn the basic mechanics of how a reverse mortgage works, which I think is important. Most of this is just knowledge, dispelling the myths and the rumors so that people can understand conceptually how this loan works. And no loan is for everybody. Okay, like I said, you know, if you're a Dave Ramsey fan and you've done exactly what he says, more power to you. I'm proud of you. But if some of those people that are a little short, this might be a nice financial option for them that'll end them up in the same place, which is no mortgage payments during retirement, or perhaps some sort of income or line of credit available to help them during retirement. All right. Any final questions? All right. You have been a great audience. I appreciate it very much. Class is dismissed.